Spoke about three major special situation cases, right? Like mergers and acquisitions, or like some transition happening in the promoter management. Any other examples that come to mind where you spotted the opportunity very early on or during this special situation case?
Yes, there are so many. So I'll talk about a merger arbitrage situation. So in late 2022, there was a stock called Equitas Holding.
Hmm.
Basically, the Equitas Holding and Equitas Small Finance Bank were about to get merged together, and there was a merger arbitrage discount of for a certain number of shares of Equitas Holding, you would get a certain number of shares of Equitas Small Finance Bank. And at that particular point of time, based on the stock price of both the companies, there was a 15% merger arbitrage on the table. The merger would get completed in the next 6 months. At the same time, the banking industry was undergoing a tailwind and undergoing an upcycle. And the stock of Equity Small Finance Bank was also available at a very cheap valuation of just 1.5 times price to book. So all the elements were there in place for you to to invest in Equitas Holding and the holding company, which was going to get merged. So you get upside from the merger arbitrage discount. You get upside from the banking industry tailwind. You also get upside from the potential valuation re-rating of the underlying business, which is getting merged, which is Equita Small Finance Bank. So when you're investing in these merger arbitrage situations, you have to have a favorable view on the underlying business, the primary business which is underlying. So basically, that is when these merger arbitrage investments turn out to be very, very profitable. So the next special situation I would like to talk about is that of promoter or management change. So there you get potential big multi-baggers. So a few years ago, the Murugappa group basically took over CG Power at I think 12, 13 rupees per share, and that stock went up more than 50 times in just a few years time from there. So when you're investing in promoter or management change situations, the ideal situation is one where the underlying business is of a good quality or the underlying asset is of a good quality, but it's being badly mismanaged, or just there's a lot of low hanging fruit in terms of low margins or inefficiencies, which the new promoter can basically take care of and start. That is when you get the delta or the big percentage changes in your profitability. That is how you get the big multi-baggers in promoter management change situation. The big multi-baggers do not take place when the promoter management change is happening in a business which is already being run very well. The big multi-baggers take place when the business being acquired was not being managed properly, because investing is all about delta, the rate of change. That's what we need to focus on.
Hmm. Any other examples, like when it comes to rate of change, applying rate of change to your core investment philosophy? Because there are so many businesses, like in this mergers and acquisitions case. Also, there might be delays that might happen. A merger might not happen in the foreseen time that it was decided to happen at, or like the person who's coming in charge in terms of a promoter change which is happening, they might not execute as well as one would hope, right? So there are things that can still go wrong even if you find like a ripe opportunity and it doesn't turn out the same way. So how do you notice these rate of change opportunities, and then also where are you discovering some of them? Because while in hindsight I can know like all these opportunities were there, but how do you find it while before it's about to happen?
I'll talk about, you mentioned that some cases do go wrong. So we have got many examples of, these things going wrong as well. So for example, India Bulls Real Estate is a prime example. And the Embassy Group was going to take over India Bulls Real Estate, and there was going to be a merger. It took a long time for that particular thing to happen.
In fact, that was the example I was thinking about in my mind also, but yeah.
Yeah, so basically, so that's why, when you are investing in these special situations, you should be aware of the base rates of success or potential for delays or some mishaps happening. That's why you diversify. You do not just place all your bets in one single company. You basically diversify your bets, and when do you understand when to bet big? Or no, you basically bet big when in case of merger arbitrage situations, for example, if the business being merged is not of strategic national importance, for example, if it does not belong to telecom or defense, there's a reasonable chance that the merger will go through. So you basically size your bets accordingly. And if the incoming promoter or the new promoter has got a very solid, strong, established track record of wealth creation, for example, the Murugappa Group I mentioned, that is when you gain much more confidence that the chances of them not being able to execute is very low. So that again influences your position sizing. So I think I always prefer takeovers by promoter groups rather than takeovers by private equity, because private equity in many cases are very short term. They are basically trying to take over a business, turn it around, and then flip them to the next buyer. Whereas promoter or family groups have got a much more longer term mindset when they're taking over business. So those are the situations I